A Roth conversion makes sense for a dividend investor in one specific situation, and it is narrower than almost anyone tells you. Here it is. It makes sense when your qualified dividends are not already filling up your 0% tax bracket. If they are, converting costs you roughly twice what your tax bracket says it should. Twice. Not a little more. A man sitting comfortably in the 12% bracket can pay an effective rate of 24.49% on a conversion, and there is no screen in any tax software that will show him that number. That is accurate, and I owe you the reason, because on its own it sounds like a trick. It is not a trick. It is an ordering rule buried inside the tax return that decides which of your income gets taxed first, and once you see it, you cannot unsee it. It also means two men in the same bracket, converting the same amount, can face completely different bills, and the entire difference is their dividends. Arthur and Neil are going to demonstrate that in a few minutes. Both 57, both with $600,000 in a traditional IRA, both with $20,000 of other income, both converting exactly $40,000 this year. One of them pays $4,630 for it. The other pays $9,797.50. Before the mechanism, the numbers you need, because everything here runs on two thresholds. For tax year 2026, from IRS Revenue Procedure 2025-32, qualified dividends and long-term capital gains are taxed at 0% as long as your taxable income stays at or below $49,450 if you are single, or $98,900 if you are married filing jointly. Above that, it is 15%, all the way up to $545,500 single. Qualified dividend, if you have not met the term, just means a dividend that gets the lower rate. Most ordinary company dividends qualify if you held the stock long enough. REIT dividends and money market dividends never do, and the IRS says so explicitly in Publication 550. Now stack the standard deduction on top. For 2026, it is $16,100 single, $32,200 married. So a single person with nothing but qualified dividends could receive $65,550 of them and owe zero federal income tax. A married couple, $131,100. Your own calculation is short. Take the 0% ceiling for your filing status. Subtract your taxable income before dividends. What is left is your headroom, and it is the only number that matters in this decision. If you would rather have it done for you, the free calculator in the description will run it. Hold on to the word headroom, because I am coming back to it in about 5 minutes, and it is going to behave in a way you are not expecting. Now the mechanism, and this is the part nobody explains. When the IRS computes your tax, it does not treat all your income as one pile. It uses the qualified dividends and capital gain tax worksheet, and that worksheet stacks your income in a fixed order. Ordinary income goes at the bottom, wages, pension, interest, and crucially any money you convert to a Roth. Qualified dividends and long-term capital gains go on top of that pile. Then the rate is decided by where each dollar sits in the stack, not by what kind of dollar it is. So a Roth conversion, which is ordinary income, does not just get taxed at your ordinary rate. It raises the floor underneath your dividends and shoves them upward. Dividends that were sitting quietly in the 0% band get pushed into the 15% band, and you pay tax on income you were not touching and did not intend to disturb. I call it the dividend squeeze, because your dividends get compressed between a rising floor and a fixed ceiling. Which brings us to Arthur and Neil, because the arithmetic is much clearer with two people in it. Arthur and Neil, both 57, both with $600,000 in a traditional IRA, both with $20,000 of ordinary income coming in, both single filers, both taking the standard deduction, both converting $40,000 to a Roth this year. If you filled in a tax organizer for these two men, every single box would match. One difference. Neil holds a taxable brokerage account paying him $40,000 a year in qualified dividends. Arthur holds the same amount of money in growth stocks that pay nothing. Before I give you the bill, take a guess at the gap. Same conversion, same bracket, same age, same everything a preparer would ask about? Hold a number, because most people guess a few $100s. Arthur first. His $20,000 of ordinary income plus the $40,000 conversion minus his $16,100 standard deduction gives him $43,900 of ordinary taxable income. The tax on that is $5,020. Without the conversion, he would have paid $390. So the conversion cost him $4,630, which is 11.58%, right about what you would expect from a man in the 12% bracket. Neil now. His ordinary side is identical, so he also pays $5,020 there. But his $43,900 of ordinary income has eaten almost all of his 0% room. The ceiling is $49,450, so he has $5,550 of headroom left. His dividends are $40,000. 5,550 of them stay at zero. The other 34,450 get pushed into the 15% band. That is $5,167.50 of tax on dividends he did not sell, did not increase, and did not touch. Neil's total cost of converting is $9,797.50, 24.49% on a $40,000 conversion against a bracket that tops out at 12, 2.12 times what Arthur paid for the identical transaction. Before he converted, Neil's dividends were completely tax-free, not taxed lightly, not taxed at a reduced rate, but genuinely zero. The conversion is the thing that created the bill, which raises the obvious question of what you do about it, and there are three answers that actually work. The first is to convert less. Headroom is a quantity, and you can fill it deliberately instead of blowing past it. Neil could have converted about $5,500 a year and paid almost nothing extra on his dividends every year for as many years as he liked. The second is to convert in the right year rather than the right amount. A year when your dividends are lower, or a year before Social Security starts, or the year after you stop working and your ordinary income collapses. Which brings back that word, headroom, because headroom is not a fixed feature of your finances. It moves every year, and in most people's 50s and 60s, it moves a great deal. The third is the one nobody likes. Change what the taxable account holds. Neil's problem is not that he owns dividends, it is that he owns $40,000 of them in a taxable account while trying to convert. That is a real option, and it has its own costs, including capital gains on the way out, so I'm not going to pretend it is free. Now, the two things that make this worse, and I have been saving them. The first is Medicare. If you are within a couple of years of 65, a conversion raises your modified adjusted gross income, and Medicare reads that number 2 years later. The Centers for Medicare and Medicaid Services set the 2026 standard Part B premium at $202.90 a month, with surcharges that start above $109,000 single or $218,000 married. Those surcharges are steps, not slopes. $1 over a line moves you a full tier for 12 months. There is also a wrinkle with the 3.8% surtax that is worth getting right because it cuts the opposite way to what people assume. The net investment income tax applies above $200,000 of modified adjusted gross income single, $250,000 married. A Roth conversion is not itself subject to it. The IRS excludes retirement account distributions from net investment income, and it says so in the instructions to Form 8960. But the conversion still raises your modified adjusted gross income, so it can be the exact dollar that pushes your dividends over that line for the first time. The conversion is not the target, it is the ammunition. And one more piece of structure people get wrong. There are two separate 5-year clocks on Roth money, not one. The first runs once per person and starts on January 1st of the year of your very first Roth dollar, and it governs whether your earnings come out tax-free. The second is a separate clock for every individual conversion, and it governs the 10% penalty. So a man who converts once a year from 57 to 62 is running 6 different clocks at the same time, each with its own end date, distinguishable only by the year it started. The second thing that makes this worse is that there is no undo. Before 2018, you could reverse a conversion, which people used when a position dropped after they converted. The Tax Cuts and Jobs Act removed that, and the IRS states plainly that a conversion made in a tax year beginning after December 31st, 2017 cannot be recharacterized. Convert. Watch the position fall 20%, and you still owe ordinary income tax on the value before it fell, permanently. So here's the mistake, and it is not converting or not converting. It is asking the wrong question first. Almost everyone starts with what bracket am I in? That question is correct for someone whose income is a salary. For a dividend investor, it is the wrong starting point, because your bracket does not tell you how much of your 0% room is already spoken for, and that is what actually prices the conversion, which is the whole thing. So let me say it as directly as I can. What a Roth conversion costs you is not set by your tax bracket. It is set by what your dividends are already doing inside that bracket. Arthur and Neil were in the same bracket on the same day with the same money and the same plan. The tax code charged one of them twice as much as the other, and the only thing it was reading was a brokerage statement neither man thought was part of the decision. So here's what you own now. The 0% ceiling, $49,450 single and $98,900 married, plus your standard deduction on top. Headroom, which is that ceiling minus your taxable income before dividends. The stacking order, ordinary income at the bottom and dividends on top. The dividend squeeze, which is what happens when a conversion raises the floor under income you are not touching. 3 ways to manage it. Convert less, convert in a different year, or change what the taxable account holds. And two things that make it worse: the Medicare look back and the fact that there is no way back. Arthur was not smarter than Neil. He just happened to own something that paid him nothing, which for once and only for this one decision in this 1 year, worked in his favor. Tell me where you land and be specific, because this is one where the comments teach me things. First, do you know your headroom? The gap between your 0% ceiling and your taxable income before dividends? Second, if you have converted before, did anyone ever mention the stacking order to you? And third, for anyone within 5 years of 65, had you connected a conversion to your Medicare premium 2 years later? Put it below. If this made you want to check whether your tax-deferred balance is even where it should be for your age before you start moving money around. How to know if your 401k balance is actually behind for your age is the one to watch next. None of this is financial advice, and I am very much not your accountant. It is Revenue Procedure 2025-32, Publication 550, the Centers for Medicare and Medicaid Services Premium Tables, and arithmetic I ran in front of you. Take it to someone who can see your whole return before you act on it. Here's the math. You decide.